All right, Cole, topic of the day. How much more return on investment should investors be looking for if they're investing in private securities, a real estate syndication, a private equity fund, versus investing in public markets, investing in companies listed on the NYSE, NASDAQ? And I think the conversation is really directed at two audiences today. Of course, there's the investor base, right? People thinking about what return profile do I have to get? What should my ROI be? But then there's also the entrepreneur, founder, business owner who's thinking, okay, I have a new business I want to take to market. I'm looking for investment. What kind of return profile do I have to be giving to potential investors to make them interested here? They're going to have a market standard that they have to keep up with, numbers that they're going to need to meet to attract to really a whole swath of different ranges of investors. Let's take, for example, 3 different asset classes and talk about what the differentials might be from an investment return standpoint. So I'm investing in I have these 3 options, right? I can invest in the S&P 500 index.
Yes.
We know that historically 7 to 8% a year return if you're rolling back in dividends and you leave it in for an extended period of time. Of course, if you invest for 3 months and you're speculative trading, you're gonna have some differences there. So option number 2, I'm investing in a private equity fund managed by Fidelity, somebody everybody knows. Third, I'm looking at a private investment opportunity in a real estate syndication or a tech startup or a business based around a consumer product. We're seeing a lot of action these days in beverage companies, alcohol companies. We're obviously in coffee. What should investors be looking at from an overall return perspective to decide between those 3 investment options?
Sure. I think we need to take a step back and look at liquidity between the 3 options and also the diversification of the asset pool. So let's look at S&P 500. You know, you're going to have investors who are looking at long-term periods typically. You're looking at whole market cycles, and they're looking at 7 or 8% returns over the long run of these securities. Which is a good return for most investors, right? 7 or 8% is pretty good. The reason why it's theoretically so low is that you can pull out your money at any time, right? If I want to liquidate my portfolio in an S&P 500 fund, I can liquidate it in 13 seconds. If I have Vanguard S&P 500, you know, you're ready to go. I want to move $1 million from S&P to a new house in Connecticut. It's easy. It's very simple. Now let's take a typical LP GP fund managed by Fidelity, a private equity fund, like Adam mentioned. You know, usually what we see our high net worth crowd being interested in is really long-term IRRs, somewhere in the range of 12, 15%. Those are net IRRs. That's after the asset manager strips any fees, expenses, closing costs, anything like that. Now, investors need to realize there is an active market for buying up LP shares for large GP funds. There's a whole area of the private equity market that just goes around and provides liquidity for syndicated, basically LP buyouts. So if you have an investor that has a $2 million commitment in an LP fund and suddenly has a liquidity event in his life, you know, there's whole funds out there that says, okay, I'm going to bid on investor A, C, and E, and we'll say a moderate discount on their monthly NAV, and they'll come in and buy. Now, on the last example that Adam gave, that's the syndicated real estate fund individual portfolio company. You know, the yields that we're seeing from investors that make it interesting, especially for individuals, which I would say have probably a slightly lower yield preference and total return preference as opposed to an institution, is really 20% above, 20% and up.
Yeah.
So for things like, let's say you're doing a syndicated hotel deal or multifamily deal, if you're not getting equity stacks that can return over the long run, IRRs above 20, I don't think investors are going to care. I don't think they'll be interested.
I think that's right. I think the 2 big ticket items that you're hitting on are liquidity premiums. Obviously, things that you can buy and sell in an instant remove some of the risk from an investment, so the return on that investment is going to be lower. But also, it's a time value of money question, in the sense of, if I have to put my money into an S&P fund, or I want to put my money in an S&P fund, I open a brokerage account, I fund it, I put the money in.
That's right.
If I want to invest in a startup, I have to vet the business model. I have to vet the entrepreneur. I have to think about the product market fit. All these different, call them silos of work that I have to go through. I have to get paid a lot more, or should get paid a lot more for the time that I'm going to have to put in to do something like that, because of it costs me basically money, my time to do this.
Absolutely.
But also that lack of liquidity is present in a lot of these private market assets.
I agree. And to kind of break it down further, I think we need to break down portfolio investments into what I would say a P&L business and a balance sheet business. So for a balance sheet business, it's something like Adam and I run at Green Coffee. You're heavily collateralized. When we raise capital, we're raising to put into portfolio assets, farms, infrastructure, things that you can touch and feel. So you're building out this balance sheet. So in the event that something goes wrong, you can't lose it all. It's nearly impossible to lose it all on major balance sheet businesses. The other are things like P&L businesses, right? So tech startups, things that are in the services space, you're investing in a consulting company. Those are businesses that maybe you do a $20 million capital raise, but you buy $1 million of CapEx, right? It's just, I'm buying computers in an office that's rented or triple net leased, and that's the entire balance sheet.
Yeah.
So if something goes wrong with your revenue cycles, your receivables become outdue, and you have cash flow issues, there's no assets to pull upon. So the reason I bring up balance sheet businesses and P&L businesses is I think there's a large difference in the yield expectations and the total return expectations from investors, right? So for a balance sheet business, the example I gave previously was a syndicated real estate deal. I think 20% would be a target that you really need to hit for high net worth individual LPs to be interested in. I think if you're going to raise into a portfolio company, especially in a tech company, if you're not hitting total return expectations where the investor can visualize how the business is going to proceed, what assumptions go into whether it's your financial modeling or how the business is going to grow and build an ecosystem around it, I think you really need to be above 35% for an individual investor, because it is higher risk. Balance sheet businesses basically have almost like an insurance bottom, whereas a P&L business has, you can lose it all.
If you're watching this and you're thinking about raising money, you're on the other side of the coin from being the investor, and you're syndicating the hotel project you mentioned, or you're looking for investment capital for a startup, these are things you have to be aware of as well. If you're going to go out to market and talk to people about 8% returns, 10% returns even on a hotel project, you have to understand what your competition is, and your competition really is almost a guaranteed 7 to 8% return in the S&P with no work required. So you have to be cognizant of the premium that you have to give people. Otherwise, you're kind of hoping that people are not aware of their optionality.
Definitely.
Or they like you more, I guess. There's a personal element to it that we're not talking about from a purely financial standpoint. Something to be aware of.
Definitely. And I think if you're raising capital, you need to know your audience of who you're raising capital from. In a syndicated real estate deal like Adam has mentioned, maybe one party is a debt lender and you have the relationship, you have a bank that you're used to working with on all your projects, and that's easy to get that portion of the stack. Maybe you have another, that's 70%, maybe 30% is LP and GP equity combined. If you're going out to LPs, especially in today's market, I'd say in the US with a development project, there's a lot of risk attached to that. So you need to have yields and IRRs on a holistic basis that match that risk. Today, I think it's a lot more difficult, and we've talked about this in the past, it's more difficult to get that in real estate. But it's something we're seeing in the private market space as well for individual, let's say, sponsors of portfolio companies. I think sponsors are going out and having to do more, let's say, financial modeling than they've done in the past. We are seeing more LP investors, high net worth guys, come into that private market space, and they're looking at it in more of a, I would say, let's put it into a hedge fund view instead of a venture capital view. People typically think of venture capital of how coming to a valuation and saying, they could be this in the future. We have this acquisition cost of a client. This is the total addressable market. They're going to control 10%, so it's worth some kind of discount rate on that 10%. We're seeing LP investors come in that are very, very intelligent, and they want you to be able to map out the financial progress of the company with the use of capital that you're doing now and map in potential future uses of capital. And basically you're working into discounted cash flow models and whatnot that I don't think that most VCs would be doing or historically have done in the past. And that's really more of that hedge fund kind of approach. But I think it's a good thing.
Yeah.
I think it's a good thing. I think it's good for founders to be able to map out their financial progress, what they expect to achieve for their investors, what they expect to achieve for all their stakeholders. And I think basically the moral of the story is LP investors today, I think, are getting smarter every day. They have more transparency in the market. More opportunities are becoming available, and they're able to say, this is product A, this is product B, this is product C. This is the general return profiles that I think I can get out of each, and then what's my understanding of the risk profile underneath. And I think it's, a market is basically evolving, especially here in Latin America, and it's very exciting.
There's a lot of discussion now in the capital markets about how to close some of this liquidity gap to potentially make these huge pools of non-publicly traded assets appealable to a wider investment base. And we're looking at statistics of $5.8 trillion of value held in private equity investments, a US real estate market, just the US alone, holding $36 trillion in value.
Yep.
People are starting to think about how can we securitize this, how can we pool these assets in a way where they are fungible and people are able to trade them and open up new investment products and again close that liquidity gap. Some of the things that we're seeing that are pretty interesting are you're seeing some of the big stock exchanges globally, NASDAQ, the London Stock Exchange, opening up basically opportunities for private securities to trade like public securities.
Yes.
The NASDAQ now has its own private market. The London Stock Exchange is talking about opening one day every 6 months or one day every quarter a trading day where private securities trade just as if they were public. A lot of people are focused on this issue with blockchain technology and tokenization and all these topics that we're seeing come up in the markets today. Where do you predict things are going in closing this liquidity gap and opening more private assets to public investment in the future years?
I think you're going to see a couple major points. One, tokenization, securitization of private assets. This is the next frontier of capital markets, and it's going to happen. Now, there's no clear leader right now. We've personally have diligenced a lot of platforms that are doing securitization of private assets via tokenization or via blockchain technology, usually proprietary blockchain technology on the company basis itself. And all the technology seems to be viable. All of it seems to be very interesting, but there's no major player. They're doing they're still in beta mode, they're still doing test modes. What I'd expect to see is the two markets that Adam just briefly mentioned is, we're going to see private equity funds tokenize and securitize and real estate. If you can cover off those two major markets, you're going to cover off at least 50 or 60% of all the private assets that exist in the world. So the reason why a lot of these financial services companies are moving into private securitization is because, one, they have to, right? Running a brokerage company these days is a no-win business. You cannot compete as a brokerage, as a personal brokerage, with someone like Scottrade or E-Trade that'll trade for $1 a stock, right? As financial markets become more sophisticated, the cost to the consumer ultimately goes to zero.
Yeah.
So where do all the capital market guys want to go? They got to go to private markets, right? So they're using all the technology of the day to make those markets more efficient. Where are they going to focus on first? The big fish, right? They can make more capital as a percentage of a deal and make more fees as a result on the large ticket real estate, the large ticket private equity, and then you're going to see a trickle down. Same technology, maybe slightly tailored for the consumer base in the private company space. But what I'd expect to see with, let's break them into fintechs and the capital market groups like NASDAQ, London Stock Exchange, is you're going to see liquidity in these markets increase exponentially, right? More players will be able to come in, and they'll be able to trade on a more active basis. When that happens, those gaps in those liquidity premiums should shrink.
Yeah.
So all these yields that we're talking about today as being a requirement may not be the yield requirements of tomorrow. You know, if we're going out for a real estate syndication that we can offload on the London Stock Exchange on a quarterly basis in 3 months,
Yeah.
you know, maybe my yield requirement from a typical high net worth LP is no longer 22%.
Yeah.
Maybe it drops to 17.
Yeah, if the holding period's not 5, 7, 10 years like you might see.
Right, that's right. When you don't have to exit the entire investment as a result of a holding period, but individuals can liquidate their own position with their own life moments, that's when it's not as risky to the investor. More guys will be interested in the investment as a whole, and I think you'll start to see those yields shrink. And then generally investors will feel more comfortable in the private market space, especially retail investors.
I think flexibility around life's moments is a good way to put it.
Yes.
There's also huge incentive for these exchanges to be a leader here. I mean, some people forget that whether it's the NYSE, NASDAQ, the London Stock Exchange, these are all businesses and they're hunting for more listed companies.
That's right.
So if you're NASDAQ or you're sitting on the board of governors for the NYSE and you're in that board meeting and you're saying, what's our best strategy? Should we be competing against the NASDAQ for the next IPO and getting them on our exchange?
Yes.
Or are we ignoring this huge pool of assets that we'll see what regulators do and we see how the SEC responds and opens this up to people. But if they can tap into that and make those their next batch of listed companies, there's a whole portion of listing fees, annual fees, all kinds of things that they can do to grow their own businesses. So the incentives are there on both sides to start closing this liquidity gap.
Definitely. And I think the fact that it is a business, the capital markets is a business, is probably the most important thing for investors to think about taking this forward.
Right.
People aren't doing this out of the goodness of their hearts.
Yeah.
You know, we've talked to reps at the OTCs in the U.S. We've talked to presidents of the Canadian Stock Exchange, and they say the exact
companies
same thing.
public.
We've taken companies public, and we know that when you talk to the exchanges, they're not there as a favor. They say, look, we're a business. And if you can check the boxes, we want to have you, right? We want you listed on our exchanges. The amount of companies that are listing in the United States is significantly less than years ago.
Right.
Public markets are taking a beating because people are staying private for so much longer because they're not seeing the value in public markets. I think you're going to see, obviously, they're incentivized as public market participants to increase it, but the SEC will view that as well and say we need to regulate it. But also, do we want people to be operating in the regulated space, or do we want to be operating in the unregulated space? So you're going to see these guys come in and say, how do we get more guys in the public space on a security exchange that can be somewhat regulated, it's transparent, and it's safe for investors?
I think a safe prediction is that more regulation instead of less will come into the picture. Otherwise, you wouldn't have regulators.
That's correct.
But so I guess some closing words around this. Looking at it from an investor perspective, obviously it's probably comes naturally to people as they think about risk assessment and what they're investing in. But understanding what appropriate profiles would look like. What's your options in comparison to something that's relatively fixed like an S&P index and understanding that. If you're a company looking for capital, looking for investors, really critical to understand market trends, what's happening from a technological standpoint that's potentially affecting those market trends so that you're putting out really what's an appealable product for the investment capital that you're looking for.
Correct.
Anything to
add?
I
think one thing to add for the guys who are looking to be raising capital, I think a critical self-assessment of what you can actually achieve is more important than ever. Mm-hmm. I think with the intelligence of the LP investing community and specifically accredited investors being more comfortable in the private market space, participating in early stage funding rounds, like this is not a realm where the founder can no longer just go to a venture capital fund, spew an idea that's, you know, sky high valuations, the most beautiful thing in the world. You need to be able to talk in a granular fashion for someone who wants to invest $100,000 to $1 million in an LP fashion and say, you know, really selfishly, what's in it for me, right? What's in it for me for an investor? What can you actually achieve? And what's the timeline to do so? So I like seeing companies having to come down to that more granular stage and be saying, this is the grand master plan, but here's how we're going to achieve it timeline by timeline. And this is what we think on a financial metric basis we can achieve. And if you're able to do that, we think you'll be successful raising capital from investors if you can meet the yield requirements and the total return requirements of those investors. If you can't do that, I think you're going to have a tremendous amount of difficulty raising capital in today's climate.
Great advice for everybody in this circle of ours.